many countries, more than I think about 76 or some countries, are already experimenting with CBDC. China started a little while earlier, but we have also started some 2-3 years back.
Your new norm for external commercial borrowing and foreign exchange is liberalizing the foreign currency borrowing by Indian companies, removing the cost caps, widening eligible borrowers, lender, expanding end users. There are so many changes. Raising the borrowing limit you have done to 300% up, you have said that, no? That 1 billion or 300% of net worth, whichever is higher. Then all the end use also you are making a lot of complication. So is it like, are we sort of in a panic? So fast we are opening up so many things?
Yeah. First up, let me just clarify that there is no element of panic or anything, because this is not a short-term measure. If you look at Reserve Bank's stance on capital account convertibility, I think we have fairly consistently been saying that capital account convertibility is a process. It is not an event. It's not any 1 or 2 or 3 steps. So in this spirit, we have gradually been liberalizing capital account. You are in a situation today where, but for a few constraints like cost caps on ECBs or amount limits on ECBs, most of the inward remittances inward capital flows are by and large liberalized. What remains, a little more under control is how much can go outward. And that gels well with the state of development that our economy is in. Now, if you come to ECB, we have taken many steps. I mean, if you look at, one of the major things we did about 4 or 5 years back is we said that you can take any positions in the market for using derivatives as long as there is an underlying cash flow. You don't have to justify anything, suggest anything. So the process became very simple. Another step we took was hedging of your commodities. The process became very simple. Trade and trade flows have a capital account, connotation, because 1, capital account flows can come through trade flows. 2, you have trade credit and other things. Trade we are liberalizing. That is another thing we will liberalize substantially. So our process is liberalize your balance of payments, make foreign exchange transactions as smooth and as convenient as possible to the participants. So the steps we have taken in ECB, not taken, we are proposing to take because it's a draft, yes. We will receive our suggestions, is to say that you see, most of the conditions that were there in ECB were to ensure that only financially strong entities will be able to go out and borrow. For example, you keep a cost cap. Why do you keep a cost cap? You keep a cost cap because if you don't have that, even very weak entities can go out and borrow at very high costs. That affects, if any one of them fails, that affects the cost for everyone else. That affects India's credit curve. To get the same, address the same risk, what we are trying to do now is link the amount that one can borrow to the total amount that a corporate can borrow, linked to your leverage. Linked to your leverage. So if you are borrowing, it doesn't matter. It's your choice as a corporate, borrow domestically, borrow abroad. But if you want to go and borrow abroad, then your leverage cannot be beyond a certain point.
300% of net worth.
Precisely. So once we have those, and all of them are up for discussion and so on. Once we have that in place, then we don't see the need for having a cost cap. We don't see the need for having a cap on how much amount you should be able to, go out and borrow. We have given some minimum because our system is used to a minimum of 750, so we gave some other minimum for that purpose. So that is the idea. The idea is not that there is something that we need to do today. The idea is today or something that we thought of today. The idea is that your capital account transaction should be gradually liberalized. This is just one step in that gradual process, which is decades long.
And what's the deadline like this? Now we're at the discussion stage, consulting stage.
It's a discussion
Consult
stage.
stage.
We'll wait for, because there's already a lot of discussion happening in the public space. We are receiving comments. We'll wait for all that. We'll look at it. We'll evaluate them, and accordingly we'll issue. So maybe in the next, couple of months, we should be, out
Now,
with it.
just to extension of that, capital account convertibility, all the relaxation. And again, I repeat, the backdrop is the global uncertainties and all. So what are the things? Indian rupee is not fully convertible on capital account at this point of time. It's only partially convertible, right? Current account transactions like trades in goods and services are fully convertible, right? Capital account transaction like, say, investment in assets, they are subject to government limit and regulations. This is the broad contour and all. So what would be the next stage in terms of relaxations?
Same. Like I said, trade is by and large, entirely free. Anyone can do any trade. There is no control on it. There are only certain requirements about when you need to bring in your, if it's an export that it has to be repatriated within a certain time period of time, and such constraints. But we will come out with some draft suggestions on simplifying. We had actually come out already twice. Sorry. We had actually come out twice. We will finally introduce those things. If you had seen those drafts, you would realize that we are simplifying these transactions so much that when we had more than 100 directives or directions that were there, now we will just have one comprehensive regulation. So anyone who wants to understand what, we just have to read that trade. So trade is happening, ECB is happening. We will look at other areas that might happen, but going forward, like I said, inflows of capital is our first priority. Then we'll look at export, or outflows of capital. We'll look at that broadly in that order.
Everybody wants to know that, we have been so many talk from every forum, from everybody, internationalization of rupee. So actually what's happening? You have done something on the Vostro account, you have done certain fine tuning, but just for a layperson, can you explain to us? Where are we? Is it only talk or something is happening?
It's like this, most of us are extremely impatient. So, we start a policy, we want to see the results immediately. The results that sometimes the steps you have to take might bear fruit, after a long time. You look at your digital payments, for example. We introduced two-factor authentication when? About 15 years back. But digital payments really picked up about 5 years back. So policy making at some level is also taking decisions, keeping the conditions ready so that when the right environment happens, then things really take off. So that is that is essentially what we are trying to do in internationalization of the rupee. You see, earlier I have been asked, are you trying to replace, the dollar or something? Absolutely not. We are rational people, reasonable people. We know what can be achieved. The objective of internationalization is again very simple. We believe two things. We believe that Indian economy, Indian businesses will have less risk if their global transactions can happen more and more in their own currency. This is true of every country. I'm just talking of India. Sure. That's number one. So an Indian exporter who transacts in, who can do his cross-border transactions, his exports, invoiced in rupees, would over the long run have a lot less currency risk on his balance sheet than otherwise. Yes. That's there. You see, it sounds a bit counterintuitive because people say, oh, now I'm earning in dollars, you are saying I should earn in rupees. But if you really think about it, it's good for Indian business. One of the reasons advanced economies are what they are because they can largely invoice in their own currencies. So their businesses don't have to deal with that risk as much. That's number one. Number two, I believe that in the international financial system, we in the Reserve Bank believe that one of the reasons a lot of crises happen and a lot of vulnerability exists in many countries, especially emerging and underdeveloped countries is because there is an over-dependence on one or two or three currencies. So most of the currency crisis happen because there is an over-dependence. If you had an international financial system where multiple currencies are used in global trade and global investment, the absence of any one currency is not going to create global instabilities, is not going to create even regional instabilities. So we believe that for a more stable global financial system, you should have an arrangement where multiple currencies play a global role, not one or a handful. So from both these points of view, we decided that we should now start promoting rupee as a currency that can be used for cross-border transactions. You must also appreciate that, we want to be a developed country. We want to be a developed country, in very short time. If you go by, the length of time that takes other countries to get developed. We are the number 5 country now. We will probably within, next few years, go to number 4 and further, above that. Can you imagine a country which is developed among the, among some of the largest economies? I'm talking of just growth, but developed and some of the largest economies, when your currency is not commonly used or acceptable for global cross-border trades. That doesn't happen. So we have to build those things now. We have to start the process now. It takes a long time for exporters and importers and cross-border investors to change their mind, to change a currency, to change invoice patterns. But you have to create conditions so that people, actually the numbers are going up. Number of invoicing in rupees is going up, but it is still quite low. But we believe that if you create conditions, eventually you will reach a situation where people start doing them.
So 2147 by that time? Vikshit Bharat?
I expect to see better numbers much before that.
Okay, okay, sir. Okay, tell us another, I'll not call it sore point, that CBDC. So much of talk, boss, but it's not going anywhere. Where is CBDC? And why should I why should I use CBDC? Because if I'm using UPI, the money used with my bank, I'm earning interest. But CBDC, I'm not earning interest. Yes. But you, with so much fanfare, you spoke about CBDC, then cross-border CBDC and all. But where is CBDC?
Yeah. You asked 2 questions.
Yep.
Where is CBDC? And why CBDC, right? You asked 2 questions.
Essentially, what I am saying very crudely, it has not taken off.
Yeah, no, I understand. So I'll address that issue first. You see, just the question before that was, we started internationalization of the rupee. Has it taken off? And the answer was that in policy making, you initiate a lot of things, not because they need to immediately take off, but you have to create conditions which will help things to take off. CBDC is another such, another such policy initiative. There are reasons why CBDCs are necessary. I will come to that later. Right now, what is happening is many countries, more than, I think, about 76 or some countries, are already experimenting with CBDC. China started a little while earlier, but we have also started some 2-3 years back. Our numbers are also increasing. Number of transactions are, I think about 10 crore transactions have already happened. There are a large number of CBDC account holders, merchants, everything is there. We do not want to rush, or what we have been calling a pilot since 2022, we do not want to launch it full scale for many reasons, but primarily for 2 reasons. One, that everyone in the, globally is just starting off, different use cases. ECB, for example, is looking at wholesale CBDC use cases and so on. There is a lot of interest. They are starting that. But everyone is waiting to see what impact CBDC will have on the rest of the economy. You have to understand so that you can calibrate the way CBDC needs to be introduced. So everyone is, hastening slowly in the sense that everyone wants to know, I don't want to rush through. For example, should CBDCs have some sort of a cap, given the possible risk that they can replace bank deposits? Okay? So we don't know that. So we will have to do those things. So right from the beginning, it was clear in our minds. In fact, I've been talking at least for the last 2 years saying that we are in no hurry. We are in no hurry. It's something we introduced, right? Everything is ready. Technologically, we are by and large ready. Use cases, we are by and large ready, both retail and wholesale. Programmability, which is something that, that will distinguish CBDC from other payment instruments. UPI, for example, we said one, is something that we are trying out now. Programmability, we are trying it out for many government use cases, benefit transfers. For example, government wants to, give a loan which can only be used for acquiring, let's say, irrigation equipment. So government would like to give this money to the farmer, and that money should only be used for irrigation equipment. In fact, we are running a project on that. Similarly, education loans. You want it to be used for buying books or paying a school or a university. So there's some programmability features going on there. So there are multiple programmable CBDC experiments we are trying on as part of that pilot. Again, even today, I just want to repeat that we are in no hurry. If you ask me 6 months down the line, I would probably still say that. If you want to launch, we can. We are ready, but we are in no hurry. We want to go slowly. That's the where part, where we are. We are progressing, but we are in no hurry to launch full scale. Why CBDC was the other question. You say, I have UPI. Why do I need CBDC? One issue I partly answered was programmability. You have a lot of use cases which you can do with CBDC because it's a token. Because it's a token, program can be written on it. That's number one. Number two, one of the, in the payment space, domestically everyone is doing well. Most countries have fast payment systems. India's UPI is probably the best. But there are other countries also have them. Domestically, payment systems have really evolved. But in the cross-border space, there is absolutely no improvement as such. It still takes 4 to 5 days for retail transactions to settle. It still takes 6%, 5% for very small value transactions, the cost of transactions. Whereas in the domestic space, settlement is almost instantaneous. Cost is almost zero everywhere.
Free, yeah.
So we believe that CBDC, and our analysis suggests that you will not solve this problem by using bank money. To solve this problem, the best answer, by bank money, I mean transferring money from one bank to another. Because it has its requirement. Banks have their own costs. When you transfer money from my bank, me to someone sitting in the US, it has to go from my bank to that bank's correspondent bank to the receiver's bank through his correspondent bank. Everyone has a cost. So this cost cannot be reduced. Whereas if it is CBDC, there is no settlement, there is no risk. It can just be handed over. So cross-border space, the answer to the problem we have today, on which G20 and everyone else is sort of trying to settle that problem, the answer lies in CBDC. So, no fast payment system can solve that cost issue and time issue. So given these two things, we believe that CBDC has certain unique uses, like in the cross-border space, like in programmability, which cannot be settled by transfer of bank money. And therefore, CBDC has unique uses.
But you have to wait for that.
Well, we have to wait because the global narrative of token money is not very rigorous. Everyone talks about cryptocurrency, everyone talks about stable coins,
Yeah,
but
just,
not enough
I just
discussion.
want to understand. Meanwhile, is there any change in your approach, RBI's approach to cryptocurrency? Because particularly when it's legalized now, of course, this is not cryptocurrency. The US, I'm talking about stable coin. So in that context, any change in your approach to cryptocurrency?
No. The simple answer is no, because our stance on cryptocurrencies, both unbacked cryptocurrencies and stable coins, is decided entirely by the way we have analyzed and looked at what the basic character of cryptocurrencies and what purposes they can serve. And the answer we reach, which we have been telling publicly for so many years now, the answer that our analysis is that cryptocurrencies do not serve any purpose, cannot meet any use case, and I underline the fact any. I'm not talking using these words loosely. That existing forms of money cannot do better. Okay? So we, for example, feel that unbacked cryptos have no underlying cash flows, have no issuer, and therefore they are no one's liability, and therefore they have no value. It's a different matter. I mean, people are willing to buy things for large amounts, that's their choice. But our assessment is that unbacked cryptos have no value. They are, number one, not financial assets. That has not changed. As far as stable coins is concerned, yes, stable coins, because they are backed, the value of stable coins is not something that is in question. But the risks of stable coin to an economy, particularly an economy like emerging economy like India, is that it carries a huge risk of replacing your currency and your policy sovereignty.
So you have reservations about stablecoin, but not saying no to it.
We don't have reservations.
Okay.
We are very clear in our mind that stable coins do not serve a purpose, that cannot be done better with CBDC. Okay. And introducing stable coins would, not even on balance, would pretty much create a lot of policy concerns and issues that are best avoided.
You said it, sir. Now, just want to understand, I have a few more questions on other things important as well. Before that, there's a lot of confusion in that payment space, Till now, so many years, for a decade, I think we are getting into the two-factor authentication. But now we have introduced an alternative authentication also, the OTP, and it's more sophisticated than what it had been. And then the customers and all, there's a lot of confusion. Can you just simply explain to us what is the new system?
Actually, it is, strictly speaking, we probably didn't even need to issue a regulation, because this is not something that was required. But what happened was that two-factor authentication pretty much resulted in, largely the use of, standard, simple ones like OTP, etc. They were the only ones being used. There were many other technological alternatives. As technology is improving, the authentication tools can also evolve, and the system should gradually move over to more sophisticated systems of alternatives. You see, you have a particular factor of authentication. There are fraudsters, there are bad actors who try and misuse that. So you'll have to evolve. We'll have to go over to new forms of authentication. Now, the system could have evolved on its own, but it did not. So we thought we will guide the system by saying that you need not just depend on OTP. OTP is fine. It can remain, it can be one of the factors of authentication. But we are not saying any factor of authentication is good or bad. We have just said that you can evolve new factors of authentication. We have given a framework to simplify things, that an authentication is something that a user has, that a user is, or the user knows. So that, and we have said that the two factors of authentication will be, in different categories. We have, for example, said that a compromise of one should not lead to compromise of the second one. We have said that one of the things can be a dynamic factor of authentication. These are largely by way of guidance so that the system evolves using the evolving technology.
There are many questions and the answer will be predictable, so I'm not going to ask you on rupee, what is the rupee level, because I know what is going to do and all, because we are doing activities both in spot and NDF and all. But one thing, I'll not call it a concern, but I'm drawing your attention, and because I know you don't go to bed without solving the crossword puzzle, New York crossword puzzle, that's your thing. So here it's a puzzle for all of us. Just explain to us, sir. In the foreign exchange reserves, we have been talking about this much and all, I'm not getting to the numbers and all. But RBI has churned a substantial portion of the foreign exchange reserves in the past few years. Basically, what happened is this, you are in the buy and sell figures and all. So you are selling it because it was an old price, you are making tons of money out of that, buying it at a new price and all. And in the process, you are making tons of money. Who's the beneficiary? The government. You are giving the dividend. But I think we have reached a situation here, your ability to make money out of this will be restricted, so which means your ability to give that much of dividend to government also will be impacted. Is that correct reading, or how do you sort this out?
What you're saying is factually not, one cannot question. You said that to the extent your ability to make money will change, the amount of surplus you transfer to the government will change. That's factually correct.
Change for lower.
I mean, lower or upper or
Yes.
whatever.
Yep.
You see, the point to keep in mind here is that yes, a central bank, if it makes more money, more will be, transferred as surplus. But a central bank does not function keeping surplus as one of its objectives. It happens in the normal course of its business. You see, all surplus transferred by any central bank anywhere in the world is basically seigniorage income, is largely seigniorage income. And seigniorage income, by definition, belongs to the people and therefore should go to the people, which in this case is the government. Money should go to the government to be spent on people. So that's perfectly fine. Whether going forward it will come down, I have no way of knowing, and I'm being very,
The logic, sir, I said, because you are a New York puzzle solver, so the logic is this: the old stock you have almost depleted, and the new buying at a higher cost.
Okay, that is just an accounting issue you are raising. We follow a standard accounting that others follow, which is that whatever is acquired, we reflect it in our books at the average cost of acquisition. And whatever is sold, we sell it by booking profit or loss against that average cost of acquisition.
Yes.
So, so strictly speaking, what you are worrying need not be a concern, because we have been buying historically. So the average cost is changing. It is going up with time, but it is also changing.
Okay.
So, so typically whenever we sell, if we are selling when the rupee is depreciating sharply, there will be a profit. If you are selling when the rupee is appreciating sharply, there will be a loss. Okay. So you can work out for yourself.
Okay, but you are more active in NDF market, right? Am I correct?
Let me not answer that. That's not an area I deal with.
Okay,
yeah.
Okay. Let's get back to other part is the bond market. You ask any bond dealer, and I am not talking on their behalf that they have to cut their losses and all, not kind of thing and all. But the interest rate cut, the sharp cut that you had done, and of course then the reversal instance and all kind of things and all. So this, at the longer end, I'm not getting into all the technicalities and all, but at the longer end, it has not, it's not percolated into their 10-year yield if you are looking about that and all. So it's not that, and there could be many reasons. One of the reasons is RBI changing the stance neutral so that forward-looking market looks at and all. So what needs to be done? Essentially what I am saying is this: the transmission has failed in the longer end. Am I correct in saying that, or I'm
No,
talking rubbish?
in
Rubbish?
fact, I would very strongly suggest that that is not the way to interpret the action that is happening in the bond markets. You see, all financial markets basically try to factor in their expectations into the prices, right? This is true of a stock market. This is true of bond market. This is true of money market. This is true of every market. So, if the bond market is expecting that the central bank going forward is going to hike rates, they are not going to wait until the central bank hikes rates and then raise bond yields, right? They are going to raise bond yields the moment, they are going to price that in well before the hike in rates. Similarly, if they expect that bond yields are going to go down, central bank might cut, they will reduce rate. Central bank action is one of the factors that they build into bond yields. There are many other factors. It depends on demand and supply for any reasons, regulatory reasons. Businesses might suddenly decide that because of global risk, let's move out of risky assets to bonds. That can be another thing. They factor in everything. Now, we are just looking at one factor of those, which is a major factor, undoubtedly, that what the central bank is doing and how it is pricing in. Now, you are saying that we did not price it in. A lot of that follows from this tendency to look at when the central bank started hiking rates, what was the bond yield then, what was the bond yield later, and what is happening now, right?
Yep. That's how we see.
But if you look at it, let me go from the cycle where we initially raised interest rates. Bond yields were at about 6%. And the peak they reached, if I remember the numbers right, they could be off a little bit, is roughly about 762 or something.
Yes,
right?
yes.
But when the Reserve Bank started hiking rates, the bond yields were already at 712 or something. They were not at 6%. They were already 712. They had already factored in. If you look at transmission, and if you look at where the yields were by the time the central bank stopped, the hiking cycle, they were back to around the same levels. So you might feel that bond yields actually were not transmitting, but they were transmitting more effectively. They went up from 6 to 7, well before, and they adjusted because they thought the cycle is over. Now we'll have to adjust. Similarly, in this cycle, if you look at that cycle, then bond yields, from above 7 had come down to 10-year had come down to about 620, right? Which is what, 80 to 90 basis points already. It is already there. It is factored in. Only thing is their timing doesn't coincide with policy action because they priced them in advance. So that is what it is. Now they must be pricing in this. But again, as I said, there are other factors which have played a role here. The demand from insurance is a bit soft now. That is something the bond markets price in. A lot of what happens in global interest rates is what they price in. So I do not think that given the information that we have, we can definitely not reach the conclusion that they are not pricing in effectively.
Fair enough.
I believe they are very efficient.